Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Peter Cardillo, Chief Market Economist at Rockwell Global Capital. Peter, thanks very much for coming.
My pleasure.
On the show. Let's talk a little bit about the outlook. We've seen very strong equity markets recently, and that comes against a backdrop of, I think, increasing worry about the economy, sequester, looking towards perhaps a slowdown, yet equities seem very buoyant, and on the other hand, we've seen a big correction in commodity prices, notably gold. Now, gold has bounced off its lows. How do you sort of put the puzzle together here right now?
Well, to begin with, look, there's one powerful ingredient that the market has right now, and that is the Federal Reserve, which continues to pump liquidity into the marketplace. And, of course, now, you know, the Japanese are doing the same, and most likely the ECB is probably going to lower interest rates. And,
but why didn't that affect, how come gold went the other direction? If they're pumping in supposedly all this liquidity, okay, which, frankly, I've got, you know, an issue with that statement because, you know, they're also taking out a tremendous amount of interest income when they do these monetary operations. But that being said, why did gold go down?
Well, I think, you know, the reason for gold going down is, I think, was mostly technical. Now, if you want to look at it from a fundamental viewpoint, you know, let's face it, there's no inflation. At least that's what the Federal Reserve and what the central banks are telling us, that core rate of inflation is well anchored, and it isn't to a certain degree.
Yeah, but if you look at TIPS, Treasury inflation-protected securities, they're trading like at a zero rate practically. I mean, you know, it's not just that that's what the Fed is telling us or the government.
Yeah, well,
that's what investors are saying.
The market is convinced of that. There's no question about it. I mean, you know, look, we had a drop in oil prices. We had a drop in food prices. Even though these are their headline inflations that, you know, can spring up at any time. But the truth of the matter is that the economic decline in Europe has been stronger than we anticipated. Than the markets anticipated, and as a result of that, you know, you had China about a year and a half ago raise interest rates, managed to break the inflationary spiral that was taking place in China, and so that combination, right, of weaker economic activity in Europe, inflation going down in China, and obviously, you know, oil prices, the key to inflation, pretty much stable. So when you have that type of ingredient, it worked in favor of the Fed. Now that doesn't mean it's always going to stay that way, you know.
Well, are you saying maybe then that commodities are right and equities are wrong, that commodities are sort of reflecting the slowdown, as you mentioned, in Europe and China, maybe sequester here, and that, the equity market's running on sort of a valuation support because of low interest rates, but are you saying it's unsustainable?
No, I'm not. I think in the short term it's sustainable because, you know, if you look at the Q1 growth results so far, earnings were actually up about 2.2%. From last year at this time, and that really surprised me. But again, there's a caveat to that, and that is look at revenues growth. That's been declining, and certainly guidance has been very murky here. It's been on the rise. I think it's probably at the highest levels we've seen in about 2.5, 3 years. So basically, you know, the earnings seasons, while companies have beaten in terms of earnings, there is definitely a weakening trend in corporate growth earnings. Now, that brings us back to, well, then why does the market continue to move higher? Why doesn't the market forecast perhaps second quarter earnings actually being negative?
Right.
Again, it goes back to the fact that we have tremendous amount of liquidity coming into the marketplace by the Feds. Now, so far the Fed has had a very fortunate period in the sense that they have not rekindled inflation, and that's due to the
But do you think that's going to happen? Look, let's take this whole, you know, sort of paradigm of hard assets, which became very hot, in vogue over the last 6 or 7 years. People wanted to own tangible hard assets, gold, metals, oil, grains, this sort of thing. There's been a cooling off period. Do you see this as an opportunity for longer-term oriented investors to get into these assets?
Absolutely, no question about it. And I just want to bring out one other point. The fact that interest rates are near zero, and that's almost on a global basis, in Japan and now Europe, etc. That in itself attracts investors to the equity markets. You have a lot of good companies paying 2-3%, beating the bond market. So that is a major plus for the equity markets, while holding on to hard assets, right? They're non-interest bearing.
So you're saying hard assets is not the place? You're saying it's not the place?
No, I'm not saying that.
Right.
I'm saying I think the reason why we saw a correction in commodity markets, and in particular in gold, was due to the fact that, it was more technical and based on the fact that people were looking for a return. When the price of gold stopped going up, it suddenly halted a capital return.
Right.
And as a result of that, we had a technical correction. Should you
so
be buying gold at these
what's going to
prices?
bring back
Absolutely.
the positive trend? What's going to bring back the bullish trend?
Well, eventually we're going to see higher rates of inflation, and eventually we're going to see a weakening dollar. And so I think the ingredients is being set for another run in gold. Now, that doesn't mean it's going to happen next month or the month after. Sure, in the short term, we could see maybe gold gain 3-4% from these levels. That's an easy objective to obtain, just from a technical viewpoint. But, gold needs to be purchased for the long term.
But why are we going to see a weaker dollar? If we're like entering into our own period of austerity. Austerity is like we're not printing as many dollars. We're printing less. Why are we going to see a weaker dollar if, in fact, we're actually going to be issuing less dollars?
We're going to be issuing less dollar. And in fact, for the first time, in about 4 or 5 years, we're going to probably see the budget actually dwindle somewhat.
Quite a bit, actually.
Yeah.
It's forecast, I think, at about $800 billion. It might even be. I've seen some forecasts a year or two out down to $400 billion, which, as a percentage of GDP, would be like nothing.
I think that's
wishful
thinking. I think, but in any event, we'll chat about that later.
Yeah.
I just think, look, the dollar is going to weaken because while there's no question the trend in bringing down the budget is in place, the fact is we're going to have weaker economic activity. So while we have the sequester impacting the economy presently, right, and while the unemployment rate is going to still stay pretty much stuck in the 7.5-8% range for most of 2013.
The Fed's not going to move.
The Fed is not going to move.
Right.
So eventually, the unwinding of the balance sheet is going to probably cause inflation. And we're going to see gold prices move higher again.
All right. Thank you very much, Peter Cardillo. Nice to see you again.
My pleasure.
That's it for now, folks. This is Mike Norman. We'll see you next time. Bye-bye.